Section 4.2 of Topic 3 of Paper 6 looks at the requirements, the investment requirements for specialised schemes. That's specialised collective investment schemes as per the Code on Unit Trusts and Mutual Funds. And the specialised schemes that we cover in this material, money, as you can see under 4.2, money market funds, unlisted index funds and index tracking exchange traded funds, hedge funds, structured funds, funds that invest extensively in financial derivative instruments, listed open-ended funds, and closed-end funds. Now, do I need to know all this material? Well, it's not all going to be examined, nowhere near it, but some of it will be. And to be honest, in preparing for the exam, I'm really looking to get the big picture, do the questions, remember as much of the detail as I can. But it really is, it's unreasonable to know all this material. Having said that, I'm going to pick out certain points that I have seen examined, so hopefully you'll have those covered. Under money market funds, we're told that those schemes invest in short-term, high-quality money market investments, which seek to offer returns in line with money market rates. There are investment restrictions. Investments must be of high quality. Weighted average maturity of portfolio must not exceed 60 days, the weighted average maturity. So that's on average. The weighted average life of the portfolio must not exceed 120 days. No instrument acquired may have a remaining maturity of more than 397 days, 2 years if it's government public securities. Why 397 days? I can't tell you. But those points have been examined in a specific question. So this is where it really is tricky preparing for this material because there is so much detail. Are they going to examine it? An examiner may well come in and look at certain points, and they have done with regard to the investment restrictions on money market funds. It then says instruments and deposits issued by single issuer may not be more than 10% net asset value, except for 3 specific situations, and I've not seen that covered. And then there's more material on page 28 for money market funds that you should have a look through. Then we've got conditions with regard to unlisted index funds. The underlying index needs to be acceptable, and they give points that they consider appropriate with the acceptability of the index. 4.2.3 looks at passive exchange traded funds, that is index tracking exchange traded funds, and I'll let you have a look at that material. Hedge funds. Hedge funds are a scheme with flexible investment policy, holds long and short positions, invests in derivatives, may use leverage and active trading techniques. We also have the concept of fund of funds. A fund of hedged funds invests all its non-cash assets in other hedge funds. Now I'm going to skip on a bit and draw your attention to requirements for the product on page 30. And that is the minimum initial subscriptions. Minimum initial subscription for a single hedge fund is $50,000 For a fund of funds, it's lower at $10,000. And every now and then, those points pop up. Then we've got material restrictions on structured funds under 4.2.5. It continues with funds that invest in financial derivative instruments, listed open-ended funds, and closed-end funds. As ever, topic 3, a lot of detail, the majority of which will not be examined, but read through it and then do practice questions, and through the combination of those 2 approaches, you will be preparing. It's worth reflecting at this point, while we're bogged down in all this material, that the pass rates for paper 6 recently have not been too high. They've been between 50 and 60%. And remember, paper 6 is a responsible officer paper. So everybody sitting the exam has experience of working in the markets and asset management. And I believe the reason for the lower pass rates is simply the amount of detail that you've got to go through. In preparing for the exam, as I say, read the material and do the practice questions, and then you should be in reasonable shape to get 28 or more that you need to pass. Section 5, we look at collective investment schemes from the point of view of managers, investment managers, and the trustees, custodians. Remember, the mutual funds need custodians, unit trusts need trustees. Starting with the management company under section 5.5, management company must, there's a set of bullet points, be principal engaged in fund management, minimum issue and paid share capital and capital reserves of 10 million or equivalent. Used to be $1 million a few years ago, it's now 10 million. Amounts due to holding company can be included within the capital as long as amounts are subordinated to all other liabilities not repaid without prior SFC consent. I think that's just a little bit too much detail. Should be no material lending and have positive net assets at all times. I would pick out the first 2 points and the last 2 points as having been examined in the past. Details on management and the internal controls of these management companies. Well, the points that are being listed here are to make sure that it's a substantial management company. It's not a one-man band. It's not somebody that just set up a business with a computer and an internet connection. Read through the requirements there. Licensing. Now, do you need to be licensed to be an investment fund manager? If you're operating in Hong Kong, you will need to be licensed for Type 9 regulated activity. If you distribute product that is not your own funds, then you will need to be Type 1 regulated as a dealer or a distributor of funds. Then says for the management companies based outside Hong Kong, it does not need to be licensed by the SFC. So for example, if we had an institutional fund manager where the funds are managed in Edinburgh, Scotland, not in Hong Kong, but the product is distributed in Hong Kong, then the distributor will need to be Type 1 licensed, but the asset manager in Edinburgh will not need to be licensed because they are based overseas. Having said that, overseas-based management companies need to have a similar regulatory regime to Hong Kong. We're told acceptable jurisdictions overseas include Australia, France, Germany, Ireland, Luxembourg, Malaysia, Taiwan, UK, and USA. So they name names with regard to acceptable overseas jurisdictions. Overseas-based management companies need to appoint a representative in Hong Kong. We deal with that a little later. And directors of a self-managed scheme, they do not need to be licensed. So if you are a management company, what are your obligations? Well, we list them there. There's a certain amount of repetition in this material from previous material. Retirement of management company, further down page 33. Provision for removal must be set out at the time of appointment. Removal by written notice from trustees or directors, trustees of a trust, directors of a mutual fund, if, and there's situations where the removal would be by written notice. And there's 1 or 2 other points. Non-Hong Kong based collective investment schemes specifically covered, top of page 34, and that's where you need a Hong Kong representative, and we've listed further details with regard to these representatives. And appointment of auditors, bottom page 34, with regard to the management company or directors of a mutual fund corporation must appoint an auditor for the scheme at the outset, or on a vacancy, the auditor leaves or is replaced. Auditor must be independent. This is important. Auditor of a management company must be independent of management company, trustee, custodian, and for mutual fund corporations, the directors. So independent auditors, please. Now, 5.2, trustees, custodians. We've referred to the trustees, custodians in earlier material. Trustee if it's a trust, custodian if it is a mutual fund, a corporation. And second bullet point there alerts us to the fact that custodians' responsibilities set out in constitutive documents in the custodian agreement. Trustees, custodians, not directly regulated by the SFC. But remember from earlier material, if a custodian gets into stock borrowing and lending, it will have to become type 1 licensed, a one-off point there. To be acceptable, a trustee custodian must be licensed bank or a trust company, etc. Now, we've seen that material before. It does come up in the exam, so be aware what it is to be acceptable as a trustee custodian. With regard to independence, trustee, custodian, and management company must be independent of each other. However, if the trustee, custodian, and the management company have the same holding company, then they will be taken as independent if they are both subsidiaries of a substantial financial institution. No definition of substantial financial institution. Neither is a subsidiary of the other. They do not have a common director. Both sign an undertaking to act independently. If that's the case, then the trustee or custodian and the management company can operate for the same scheme, even though they have the same holding company, which you would think compromises independence, but these conditions must be complied with. I've spent a little bit of time on that because I have seen a question digging into those 4 bullet points. Obligations of trustees, custodians. Well, not surprisingly, they take custody or control over the collective investment scheme property, the investments, and they hold the property of the scheme in trust for unit holders or beneficiaries of the mutual fund corporation. And there are a number of other obligations. Please read through those. Trustees, custodians at the bottom must have appropriate supervision and internal control systems. And internal control review, management of the trustee, custodian required to issue a report to describe control objective, internal control policy procedures, so people are aware of them. Engagement letter with the auditor should include terms of reference set by the SFC. Again, just so much detail. And here's what the internal control should cover. Finally, with regard to trustees, custodians, retirement, the trustee custodian must make a new appointment approved by the SFC before it can retire. Now, the trustee custodian is a very important party to the whole collective investment scheme world, because they are looking after the investments on behalf of the investors. It's the management company that, yes, decide what's going to be bought and sold, but the actual custody of the assets is in their charge. So before they move on, they must get the new appointment approved by the SFC. Retirement and new appointment must be simultaneously at the same time. We can't have any gap between one custodian or trustee and the next.